Hi everyone, what's going on? This is Franz again. I'm coming to you with another explanation video. Today I thought I'll use and we'll talk about the indicators that you see in my weekly recaps and all of the explanation videos. This is not a video about how the strategy works. It's separately looking at the indicators. Number one, what we have to realize is there are only three indicators. We do not want a strategy where our chart looks something like this here, a picture that you can find online where the guy has 1,000 oscillators and the most important part, the most important indicator, the price, is not even visible anymore. Now this is an overload. In any free trading platform these days, you get tons of indicators, but the fact is you only need a couple of them to guide you and to complement your trading approach, and these indicators will tell you everything you need to know. Now realize that there is no magic indicator. There is not a single indicator that will predict the future. Therefore, many people develop indicators depending on their research and because they their trading is better fitted by their own developed indicators than by using other people's indicators. Therefore, you get so many of them and so many derivations of different indicators, and many people are programming the same indicators, just giving it a different name. We are using the ones from Bill Williams, Profit Unity, and we use it in a pretty different way, I think, than what they do these days. It's a purely trend following use of the indicators, and therefore we want to look at, in our trend following approach, at breakout levels. We want to look at a trending market, how the indicators can help us distinguish trending from correcting, uptrending from downtrending, and we also want to see where the momentum is going. We do not consider volume in our trading indicators here. We only look at momentum, the trending indicator itself, and the breakouts. Now you can see here just a random chart. It doesn't even matter what it is. And let me turn off the price. So when we turn off the price, what we're left with is the indicators. What we see here marked by the arrows is the fractal. We have an up fractal and we have a down fractal. What we see here in these lines is nothing more than some moving averages with a certain optimized setting. And down here we have our momentum indicator. Let's now take a look at each of these individually. The fractal is very different from what you usually, when you visit the social media sites, see how people think about fractals or what they think a fractal is. Now here's an example of something that I found online. What people do with fractals is very different than what we consider something to be a fractal or what a fractal's function is. In this chart, what you see people doing is they have a current price of something, in this case the Nasdaq, and they will go back in time and they will look for a time period where the price pattern of the underlying market has been similar to the current developments. And I guess, and I'm not sure about this, I haven't researched this, I guess you have to have a certain amount of time, a certain amount of candles to look at. In this case here, you see that this person looks at the Nasdaq now, which was here at 6.2, and then 2004 to 2008 was a heavy crash, especially here at 2008. Nasdaq went down to 4.4, and this person here in August of something, 2017 here, the Nasdaq is again at that high, and this person is predicting that the Nasdaq over the next year and a half will drop down very, very heavily, just like it did here in the previous times. Now, we don't know yet if this is going to happen, but this is a purely predictive way of trading. If you get short up here because this is your approach, you're predicting the market by referring it back to a previous behavior that it did show, and it went down, so you short now. That's prediction. That's not what we do with our fractals. When we look at fractals, what really happens is you get a price moving in a certain way and therefore creating a fractal. Now, when you look at the fractal here, which is an up fractal, what happened is the price went up, it came down, it created the fractal. And what it does is it needs 5 bars, and the middle one here, the big one, the red one, is the highest bar with 2 higher lows to the left and uh, with 2 lower highs to the left and 2 lower highs to the right. And then you have your fractal. The same is true for your down fractal. It's a middle bar that has the lowest low with 2 higher lows to the left and 2 higher lows to the right. And this is actual price behavior. The price itself is behaving like this. Nothing is calculated here. It's just a kind of a way of finding short-term points in time where the market and price levels where the market is turning, where it makes a change in decision. And when it then exceeds this level, the previous fractal to the upside, when it comes through there, then it changes its direction. When previously the market decided at this point to turn to make a high here, come down, if it exceeds that level where it previously decided to go down, then we have a reason to assume it wants to go higher, because this level here is now broken, and the price is showing us that it wants to go higher. It's in real time. We do not predict, we do not take history and put it on the now. We don't take the past and put it on the present. We are just following the present, and the fractals will always mark breakout zones. When you take a look down here, you have fractals, 3, 4 of them being taken out. The market is trending up. The market is coming down. It's giving you a fractal. It turns around. It doesn't really follow through in this area, but it keeps correcting and then follows through to the upside by breaking all of these fractals here. And these fractals are nothing more than breakout points. If you want to know more about the background of fractals, which is really interesting and has a scientific background, you need to watch the Bill Williams video that I will put in the video description here. Now, this is what happens with fractals. They are nothing more than breakout levels. In my opinion, you can compare them to drawing support and resistance lines, to pivot levels, and to everything that marks for you important prices, important price levels, where if the price goes beyond it, you have a reason to assume that much lower or much higher levels are going to be the consequence. So that's it. That's all there is to fractals, nothing more. We use it for breakout points. Now, of course, you have to combine the fractals with the other indicators. You have to watch my video about the trend following approach explained to really see it work all together, and what the higher time frames role is as well. So these are the fractals. Let's now take a look at the balance zone. Now, the balance zone is the 3 moving averages that you can see here. They are colored. The most short-term one is colored in green. Then you have the medium term in red, and the long-term moving average is colored in blue. I will put the settings down in the video details. Now, these are the alligator lines named by Bill Williams. I always refer to it as the balance zone. These are our trend lines. Now, usually you see people drawing trend lines something like this, and when the price makes a lower low, then they will just change the trend line. You know, they would draw this long trend line here. They would say, oh, the trend is broken, and then they draw a new one at this point and another one here. And I don't really get that. It doesn't matter. You have to find what works for you. What works for me always has been the balance zone. And what that means is, after you get a fractal breakout, after the market is trending to the upside, what the market is doing very naturally is it will not trend forever. It will also never ever will it just move up in a straight line, come down in a straight line, move up again, and something like this. It will never happen. The market is not behaving like this. It always moves in waves, not in Elliott waves, just waves. Now, when you want to know more about that, watch my trend following approach explained video. Anyhow, the market is coming up, and after it came up, it needs to come down again. And there need to be certain levels, or there are certain levels where you can see the market coming back to. And very, very often, you will see the market coming back to previous fractal areas. Now, this is another function of the fractal here, that at this point internally on a lower time frame, the market decided to change direction. First, it came up. Now it comes down, it stays in its uptrend though and continues higher. Now after it has continued higher, it corrects again and looks for that previous decision change area or point in time. Anyhow, coming back to the balance zone, this is usually where the price will end up. And it can end up at the green one, at the red one, or at the blue one. It depends on the degree of the correction that you get and on the complexity of the correction. But what you can always wait for after an uptrend like that, like we were looking at, the market will look for the balance inside the balance zone, because this is where it would be if there was no significantly important information coming in. There's no new information coming in. So what does the market do? It just goes sideways. It goes up and down and up and down. It doesn't have a reason to trade to a completely new level of price that would reflect a higher or a lower value in that certain market or asset. So therefore, you get trends to the upside or downside when this kind of fundamental change is happening. If you want to trade it from a purely technical perspective, you would get an indication for a breakout to the upside by fractals. Then, as long as the trend is running, your balance zone is wide open. You can see that there is a lot of space between these lines. When the market is correcting, like over here, the lines are actually intertwining. And this is signifying that the market is not trending. Now, of course, the same scenario like here, you could also observe in a downtrend. The balance zone therefore indicates to us when the market is up, when the market goes down, and when the market is correcting. As a trend trader, of course, the balance zone helps you with putting your stop. You can choose to put your stop at any of these lines. You can wait for the fractal inside the balance zone. You can do many different things with these three moving averages. Considering the higher time frame, these lines help you even more. Now, when you want to enter a trend, and more details again you can find in my trend following approach explained video. When you want to follow a trend, you do not look for a market that is already trending. You're looking for a market that is intertwining. So you're looking for a market that has an alligator or a balance zone that is not going anywhere, where you have many fractals, and these fractals here will give you the kind of the average of the breakout price that you could take. Of course, you take the highest fractal and you would buy at the highest point and then follow the market as the balance zone is opening up. It comes from intertwining to opening up. And these are our trend lines. When they are penetrated, we have a stop rule and we get out. And this is how we use the balance zone. It shows us a trending market, a correcting market. It shows us when we need to get out of our position. And of course, the way or how much the price is angling away from the balance zone shows us how far back the correction could go, how drastic it could be. As you can see in here, we have a market that is really high up. However, the balance zone is moving straight. In here, we have more of a parallel situation in regard to the balance zone. Here we have candles that are not moving with a lot of momentum as the market is in a parallel kind of behavior. Here, as the high is made, we have a heavy drop back into the balance zone. And this is kind of how the market comes back to the balance zone, how the balance zone is the magnet. It will always come back to the balance zone. There is no way that a market is trending forever. Even though that can mean that a market trends for decades, it just means that it won't trend forever. Now, the last indicator that we have left is the momentum indicator, and here we are also using Bill Williams' knowledge on trend trading, and all this thing does, and it's not very different to at least in parts, to the MACD or the RSI, as it shows you divergences in a market that is going up. So take a look at this movement here. It's going up. There is a higher high here compared to this one. The momentum in here, in the awesome oscillator, how Bill Williams refers to this, is the highest high showing here and the lower high here. However, as the price is showing it the opposite way, what you get is a divergence in this up move. And divergence, as you know, always shows you the weakness in the momentum and the weakness in prices going higher. And look, there is a correction happening after this divergence has occurred. This indicator can show you multiple divergences, as you can see as well in here. And you can also compare the whole thing to the hill on the right side of the chart if you compare the highs of this previous move and of this second move. The other thing that this indicator shows you, so next to what we just discussed, showing you with how much pressure the market is running up and where the pressure is not holding up, but the prices are moving higher, and this kind of giving you the idea, the indication that the market could turn and could start correcting. That's number one, what it shows us. It shows us also the degree of correction that the market is undergoing. You have an uptrend in here, and usually after an uptrend, especially when the overall time frame is also moving the same way, the market is not just reversing and coming back all the way down here. What actually happens is that first you will get an internal correction, and then you will get a major correction, so a minor correction and a major correction. And only after this has been done and there is divergence, the market can turn. But this is more explained better in the trend following approach explained video. Here we only want to look at the function of the indicator. So we have a minor correction corresponding with an AO above the zero line, and we have a major correction corresponding with an AO below the zero line. And these kind of corrections here, these different types of corrections, can give you an indication of how long the correction takes, how deep it goes, and what to expect afterwards. So after a smaller correction here, a minor correction, you cannot assume a market that is trending up like this. You can only assume a market trending up like that, which is much less trend, much less price that travels. In here, you have your major correction with a market below the zero line in the AO, the momentum indicator. That is the two things that the momentum indicator, the awesome oscillator, which is also a Bill Williams indicator, I will put the parameters down in the video description, can show you. Now, combine all of that and you have a real great trend following system that works out on the daily and the weekly time frame pretty well in all markets. And you can keep it really simple, and just taking a look here and there will give you quite a solid approach to the market. Thanks again for watching. Comment, post any questions if you have them, and I see you soon, hopefully at a weekly recap next week.